Welcome to the deep dive. We're here to cut through all that noise, take your source materials, and really pull out the crucial insights you need on one specific topic.
And today that topic is Tourmaline Oil Corp. You'll see it as TRMLF on the OTC markets or TOU up on the TSX. We're diving deep into its investment thesis, looking at data as of November 2nd, 2025.
Right. And for context, the share price we're looking at is around $43.95. That's from October 31st, 2025.
It's Canada's biggest natural gas producer.
So here's the big question, the real tension we need to explore today. Can this company, a low-cost leader in fossil fuels, can it really make this big pivot to supply the global LNG market?
Yeah, and deliver those returns shareholders expect?
Exactly. Or is it going to get tangled up, maybe even stranded by all these regulations, especially the climate ones coming down the pipeline, federally here in Canada?
It's a classic battle, isn't it? Top-notch execution versus, well, political headwinds.
It really is.
Yeah.
And we're going to look at what the valuation models suggest about that tension right at the end. So stick around for that.
It really forces you to weigh, your confidence in management against these big external uncertainties. It's kind of a masterclass in modern energy investing.
Okay, so before we really jump in, just a quick reminder for everyone listening, please like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, it helps us a lot. And for just €4.99 a month, members get that huge playlist, 500 deep dives covering the S&P 500.
And we're tackling the NASDAQ 100 next. That's exclusive for members. Plus, you can request specific stocks. Just drop the ticker in the comments.
All right, let's get into it.
Okay, let's unpack Tourmaline. We're starting with part 1, business, management, and money. Chapter 1, business understanding. So first off, what is Tourmaline? Well, it's a senior Canadian E&P company, E&P meaning exploration and production.
Right, and their playground is the Western Canadian Sedimentary Basin, the WCSB. That's prime energy real estate in North America.
Their goal is pretty classic E&P stuff. Grow reserves, pump out more product, increase cash flow, all to boost value for shareholders.
But the scale here is, well, it's massive. You can't just gloss over that. Tourmaline is Canada's #1 natural gas producer, full stop.
Wow, #1.
And #4 in all of North America. That's huge. When they make a move, the whole Canadian energy sector kind of sits up and takes notice. Their guidance for 2025 production, we're talking 635,000 to 650,000 barrels of oil equivalent per day. Per day.
And if you look at what they produce, it really hammers home that this is a natural gas story. Yeah, they have some oil, some liquids, but it's mostly gas.
Historically, yeah, around 80%. Even late last year, Q4 2023, it was still 76% gas.
So if you're an investor wanting direct exposure to natural gas prices, Tourmaline is right in the thick of it.
Absolutely. Which brings us straight to their core value proposition, what we're calling the moat. Low-cost leadership. This company has built its entire reputation and, frankly, its profitability on being incredibly efficient.
They want to drill the cheapest wells.
Yeah. Exactly. Lowest cost completed, stimulated horizontal wells. But the real lock-in, the thing that's hard for anyone else to copy, is their strategic ownership of midstream infrastructure.
Okay, let's talk about that infrastructure moat, because that's really where the cost advantage comes from, right?
It's crucial. We're talking a huge network. They own and operate 18 gas plants entirely, plus they have stakes in 13 others.
And why does owning the plants matter so much? Most E&Ps just pay someone else to process their gas, don't they?
They do. And they pay fees for it. Sometimes hefty fees, $1 or more per unit of gas just for processing and transport. Tourmaline avoids most of that. By owning the infrastructure, they internalize those costs. They control the scheduling. And crucially, their margins are protected if third-party processing rates go up. Their own costs stay low.
So they built this cost shield around their operations.
Precisely. This network, it can handle something like 3.2 billion cubic feet of gas per day. That's the economic engine driving their profitability.
And they've got the land to feed it. They have the biggest position in the Alberta Deep Basin. We're talking about 3 million acres.
Which gives them decades of drilling potential. Over 25,000 identified locations, already de-risked. They're not scrambling for places to drill.
So they own the resource and the factory to process it.
Exactly. Low cost, massive scale. But for a long time, there was this ceiling, this constraint. And that leads us to the really big catalyst changing their whole story, the LNG pivot.
Right. For years, Canadian gas was kind of stuck, wasn't it? It mainly flowed south to the U.S.
Yep, captive to the North American market, which meant Canadian gas prices, the AECO price, often traded at a big discount to the U.S. benchmark, Henry Hub.
The dreaded AECO differential. I remember hearing about that. Sometimes more than $1.50 different.
Easily. It was painful for producers. But now the game is changing. LNG export capacity is coming online on the West Coast. Specifically, LNG Canada's Phase 1, starting up in 2025.
And that's the key. It opens up new markets.
It's the key. It's a pipeline to the world. Tourmaline can now liquefy its gas, put it on ships, and send it to places like Asia, where prices can be much higher and aren't always tied to what's happening in North America.
So access to premium pricing?
Potentially, yes. Yeah. It's expected to give a structural lift to Canadian gas prices overall, a sustained tailwind.
And Tourmaline didn't just wait for this to happen, they planned for it.
Oh, absolutely. Very strategic. They locked up firm transportation capacity on basically all the major pipelines heading out of the WCSB.
So they can choose where their gas goes, AECO, Henry Hub, or now overseas LNG markets.
Exactly. It gives them flexibility and makes them less vulnerable if one market sees prices weaken. Smart diversification.
Okay, how do they stack up against peers? Like Canadian Natural Resources, CNQ, they're bigger overall, right?
CNQ is larger, yes, and more diversified with their oil sands business. But if you look purely at profitability, like profit margins, Tourmaline actually comes out ahead. Yeah, TTM net margin for Tourmaline is around 28.5%. For CNQ, it's closer to 21.25%. Tourmaline just runs a tighter, more efficient ship on a percentage basis. Higher profit per dollar of revenue.
Impressive. But there's always a but, isn't there? There's this regulatory shadow hanging over them, the federal oil and gas sector greenhouse gas emissions cap regulations.
This is the big one, the major risk to the growth story. The government is proposing rules to force emissions down, like 35% below 2019 levels by 2030.
35%? That sounds like a lot.
It is. And for a company like Tourmaline, which mostly produces natural gas, already the cleaner fossil fuel, and wants to grow production significantly, well, the industry argues this regulation basically acts as a production cap.
Ah, so it could stop them from hitting that big 850,000 BOEP target they're aiming for in the 2030s?
It could severely hinder it, yes. It creates massive uncertainty. Can the quality of the company overcome this kind of external political obstacle? That's the million-dollar, rather billion-dollar question.
Okay, let's shift focus now to the people actually running the company.
All right, Chapter 2, Management Evaluation.
And when you talk about Tourmaline's management, you really have to start with the CEO, Michael Rose. He's not just some hired gun.
Not at all. He's arguably the most successful serial entrepreneur in Canadian energy history. His track record gives investors a ton of confidence. It's like he has this proven playbook.
What's the history there?
Before Tourmaline, which he founded in 2008, he started and sold two other companies very successfully. Berkeley Petroleum, sold in 2001 for $1.5 billion.
Okay.
Then Tourmaline Oil Corp, sold in 2008 for a massive $5.9 billion.
Wow. So he knows how to build and sell energy companies for huge profits.
He does. It shows this repeatable skill. Find good, low-cost assets, develop them efficiently, and then critically sell them at the right time to maximize shareholder value.
And it's not just him, right? It's a team.
It's a cohesive team. Key people, like the CFO, Brian Robinson, have been with him across these different ventures. That reduces the key man risk somewhat.
And they have skin in the game.
Big time. This is maybe the strongest signal. When Tourmaline started, management personally invested to $253 million of their own money. They bought 30% of the initial stock offering.
30%.
30%. They're owners first, managers second. Their interests are deeply aligned with shareholders.
Okay, so with this proven team, how do they decide where to put the money? What's the capital allocation strategy?
It's all about discipline. Sure. Reinvest in the best projects, the highest return assets, and then give the leftover cash back to shareholders. Their budget for exploration and production is significant, $2.6 to $2.85 billion planned for 2025.
And where's that money going?
That's the growth engine. It's focused heavily on developing their big position in the NEBC Montney gas complex. That's northeast British Columbia.
Why the Montney? What's special about it?
The Montney is kind of the crown jewel of Canadian natural gas. You get multiple layers of gas-rich rock stacked on top of each other, high pressures. It allows for really efficient, high-volume wells. Plus, it's often liquids-rich. So you get valuable natural gas liquids, NGLs, along with gas, which helps the economics. It's the best gas base in the country, and that's where they're focusing the capital to get to that 850,000 BOEP target.
But they don't just grow by drilling, right? They buy stuff, too.
They're smart consolidators, yes. They use their efficiency advantage to buy up smaller players and integrate them. Think Bonavista Energy in 2023. Crew Energy in 2024. Going back further, they bought assets from Shell Canada in 2016.
Okay. But you mentioned returning cash to shareholders. How does that work?
This is where their shareholder return discipline comes in, and it's quite clever. It's this dual dividend structure. Think of it as a guardrail.
A guardrail against what?
Against making bad decisions. Look, they have a stable base dividend that they aim to grow over time.
Right.
They just hiked it 43% back in March 2025.
Okay, predictable income.
Right. But then, when gas prices spike and they're swimming in extra cash, free cash flow or FCF, they pay out frequent special dividends.
Variable ones.
Exactly. And the genius is, this forces them to return that excess cash to the owners. It prevents the temptation, which many companies fall into, of hoarding cash and then blowing it on a stupid, overpriced acquisition right at the peak of the cycle.
Right, keeps them disciplined.
Keeps them honest and focused. It's good financial governance baked into the structure.
What about profitability metrics, like return on invested capital, ROIC?
Well, right now, the trailing 12-month ROIC is moderate, somewhere between 6.5% and 8%. That reflects prices coming off their highs.
So not amazing right now.
But context is key here. That current number hides the incredible operating leverage they have. Go back to the boom in 2022. Their ROIC shot up to nearly 25.5%.
Wow, okay.
It shows that because their costs are so low, when prices are just okay, their returns are good. When prices are great, the returns are fantastic. They get a bigger bang for the buck when prices rise.
All right, let's get into the hard numbers. Chapter 3, financial analysis.
Okay, financials. Tourmaline is a large cap stock. Market cap around $17 billion US.
And revenue. I imagine that bounces around a bit with commodity prices.
Oh, absolutely. Perfect illustration of cyclicity. Revenue hit a peak of $7.1 billion in 2022 when prices were sky high. Then it normalized, dropping back to $4.35 billion in 2024.
That's a big swing, nearly 40% down.
Huge swing. But it highlights that it's the external market driving the top line, not some internal failure.
But even with that revenue drop, you said their margins stayed strong.
Exceptionally strong. That's the low-cost structure and the midstream ownership paying off. Trailing 12-month gross margin is still up at 47%, and net profit margin, a really healthy 34%.
So they make good money even when revenue dips.
They do. And underpinning all this is their balance sheet. It really is a fortress. Super conservative.
How's the debt looking?
Very, very low. The debt-to-equity ratio is consistently tiny, around 0.1 or just under 10%.
10% DE, that's low for this industry.
Extremely low. It gives them incredible flexibility. They can ride out any downturn without financial stress, and it makes them the natural buyer when consolidation opportunities pop up.
Okay, now, one number that might make people pause is the current ratio. It's low, 0.72x. Normally, that looks like a liquidity problem.
Right, and that's a fantastic point. For most companies, yeah, below 1.0 is worrying. But in E&P sector, especially for a high cash flow company like Tourmaline, it's often the opposite. It's a sign of highly efficient capital deployment.
How so?
They don't want cash just sitting around in current assets earning nothing. It's either immediately put back into drilling programs, which have high expected returns, or it's sent back to shareholders via those dividends, especially the special ones.
So the low ratio isn't a red flag, it's a sign they're not hoarding cash.
Exactly. You don't look at the current ratio for their liquidity, you look at their operating cash flow. They generated $823 million in OCF in one quarter Q2 2025.
Wow.
And they have over $2.1 billion available on their credit lines. Liquidity is absolutely zero issue here. The 0.72x just confirms management isn't being lazy with shareholder capital.
Got it. Okay, let's talk valuation. How does the market see them? PE ratio.
The trailing PE is around 15.2x to 15.4x.
How does that compare to, say, C&Q again?
It's higher. C&Q's PE is closer to 11.2x. So Tourmaline commands a premium multiple.
And why is that, do you think?
Well, the market seems to be recognizing their better profitability, that pure play leverage to gas, maybe the quality of the management team. But, a premium PE needs to be backed up by intrinsic value.
Which brings us to the DCF, the discounted cash flow model. The idea that a company's worth is all its future cash flows, discounted back to today's value.
Precisely. And the educational DCF model we looked at suggests there is a potential gap between the current price and intrinsic value.
What kind of range did it suggest?
The model came out with an intrinsic value estimate between $72 and $82 Canadian dollars per share.
Okay, and in US dollars. The stock's around $44 now.
Right. So converting that range, it's roughly $52 to $60 US dollars per share.
So $52 to $60 intrinsic versus $44 current price. That's potentially, what, 20% to almost 40% upside?
Potentially, yes. and this is a huge, but only if the model's assumptions hold true.
Okay, what are the key assumptions driving that $52.60 number?
Two big ones. First, that Tourmaline successfully executes its growth plan, hitting that 5% compound annual growth rate to reach 850,000 BOEs.
Okay, execution risk.
Right. And second, maybe even more critical, is the long-term price deck used in the model. It assumes WTI oil stays flat at $65 a barrel, and crucially, NYMEX natural gas stays flat at $4 per MMBtu.
$4 gas. Okay, let's pause on that. North American gas prices have been all over the place. How sensitive is that $52.60 valuation to that $4 gas price? What as long-term prices settle at, say, $3.50 or even $3?
Oh, it's incredibly sensitive. If the long-term reality is closer to $3 or $3.50 gas, that intrinsic value estimate drops and drops fast.
How fast?
So you'd lose most, if not all, of that $8 to $16 implied discount pretty quickly. The biggest chunk of value in a DCF often comes from the terminal value years out in the future, and that's heavily influenced by the long-term price assumption.
So the investment thesis isn't just about Tourmaline being a great operator. It's fundamentally a bet that this LNG pivot will successfully create a long-term floor for North American gas prices around that $4 mark.
That's exactly right. That $4 assumption is the linchpin for significant upside from here.
That's really crucial context. Okay, let's move on. We're heading into part 2, market, ownership, risk, and conclusion.
All right, starting chapter 4, market sentiment. How are the analysts viewing this mix of quality and risk?
Well, they seem pretty positive overall. The consensus rating is generally moderate buy or buy, and the average 12-month price target is quite a bit higher than the current price. We're seeing targets between C$74 and C$76.
Which implies, what, 20–25% upside from current Canadian levels?
Exactly. And we've seen some recent bullish moves too, right? Goldman Sachs started coverage with a buy. Scotiabank upgraded to strong buy.
Yeah, the news flow recently has been pretty constructive. Strong Q2 results for 2025. They laid out that ambitious exploration plan, inked that new long-term LNG deal with Uniper in Germany.
Oh, Uniper, right. The German utility.
Yep. And of course, they keep paying those special dividends, which the market likes to see.
What about other market signals? Short interest. Are people betting against the stock?
That's a really interesting one here. The short interest is incredibly low, like 0.76% of the public float.
Wow, less than 1%.
Tiny. It basically means sophisticated investors, the ones who short stocks, are not betting against Tourmaline. They see the quality, the balance sheet. They're just not willing to bet on a decline here. It's a strong market-based confirmation of the fundamentals.
Okay, but the technical chart picture is maybe a bit less clear. The stock's kind of hovering near its 50-day moving average.
It is, yeah, around $60.27. But the issue is, it's still below the key long-term trend indicator, the 200-day moving average, which is up around $63.15.
So what does that suggest? Below the 200-day?
It suggests that despite the good news and strong fundamentals, the stock has been facing this longer-term downward pressure, or headwind. And that headwind is almost certainly the market wrestling with that regulatory uncertainty and the broader energy transition concerns. Fundamentals look good, but the longer-term trend is still cautious.
Interesting tension there. Okay, let's move to Chapter 5, ownership structure, because I think this is where we see a really powerful signal.
It often is. So institutions hold a decent chunk, about 45.4%, provide some stability. You see the big names, Capital Research, Vanguard, BlackRock.
And retail. The general public.
They actually own the biggest slice collectively, somewhere between 49% and 51%.
But the insiders, management, the board, that's the key group here.
Absolutely. Their ownership is high, between 4.85% and 5.13%. That stake is worth over $1.1 billion. So they have serious skin in the game.
But it's not just the stake they hold, it's what they've been doing recently, buying or selling.
That's the crucial part. Over the last 12 months, insiders bought about $15 million worth of stock, while they only sold about $8 million. So, net buying activity, positive signal.
Okay, net positive. But let's drill down on the CEO, Michael Rose, the founder, the guy with the Midas touch. What has he been doing with his own money?
This is probably the single most compelling piece of evidence for the bulls. Michael Rose has been aggressively buying shares on the open market. He bought $6.9 million worth in August 2025.
$6.9 million.
Wow, and then followed it up with another $604,000 purchase in October 2025.
So the guy who built and sold 2 companies for billions before this one is putting millions of his own cash into Tourmaline stock at these prices.
Exactly. He knows these assets, this company, better than anyone. For him to be buying aggressively is the strongest possible signal that he believes the shares are significantly undervalued right now. It's hard to argue with that kind of conviction.
Very powerful signal indeed. Okay, let's put it all together in Chapter 6, risk assessment. A SWOT analysis, strengths, weaknesses, opportunities, threats.
All right, strengths first. These are the internal advantages, the moat. We've covered them. That low-cost structure, the integrated midstream assets, their own network handling 3.2 BCF day, the proven management team with that incredible track record, and the fortress balance sheet, rock-solid foundation.
Okay, weaknesses. What are the internal vulnerabilities?
Well, the big one is just commodity price exposure. Being a pure play on natural gas means your results are going to swing wildly with gas prices. High volatility is baked in.
Geographic concentration too, right? Mostly WCSB.
Yes, still heavily concentrated in Western Canada. Even with LNG, there's still some residual risk from AECO price differentials if things get bottlenecked. And compared to, say, oil sands companies, the reserve life is shorter.
Meaning they have to spend more just to stand still?
Essentially, yes. They need high levels of capital reinvestment just to replace the gas they produce each year. That can limit free cash flow generation, at least until this big growth phase starts to plateau.
All right, opportunities. What's the upside potential look like?
Number one, obviously, is LNG export growth. Getting that direct access to potentially higher international prices through long-term deals like the one with Uniper. That's the core catalyst.
And they're well positioned to keep buying up smaller players.
Absolutely. Further industry consolidation. With their balance sheet and operational skill, Tourmaline is the logical buyer for many smaller companies in their core areas. They can buy assets and make them more profitable, creating value through synergies.
Okay, now the big one. Threats. The external clouds.
And the biggest, darkest cloud is regulatory risk. We keep coming back to it because it's that important. The potential federal emissions cap.
This isn't just a cost thing. It could actually limit their growth.
That's the fear. If the government effectively caps production volumes, it directly challenges that growth story, that 5% CAGR assumption baked into the valuation. It's a fundamental threat to the upside case, and it's really hard to predict the final outcome of that political battle.
What else? Other external threats.
Well, the usual macro and geopolitical stuff. A global recession would hit energy demand and prices. A sudden flood of new LNG supply onto the market could also depress global prices.
And closer to home, inflation, interest rates.
Yeah, persistent inflation, it was running about 2.4% in Canada in October 2025, creates uncertainty about where interest rates might go. Higher rates could increase financing costs, although Tourmaline's low debt helps there. But inflation can also just erode margins over time if costs rise faster than prices.
And the long-term energy transition risk is always there for any fossil fuel company.
Always. If the world shifts away from natural gas faster than expected, even low-cost reserves could eventually become less valuable. Those 25,000 drilling locations potentially stranded. It's a risk you have to acknowledge.
Okay, let's wrap this up. Chapter 7. Conclusion and outlook. Synthesizing the bull and bear arguments.
All right. The bull case is straightforward and compelling. You've got world-class assets in the ground, run by arguably the best management team in the business, who are deeply aligned with shareholders. Just look at that insider buying.
Plus, the fortress balance sheet and this clear catalyst with LNG exports opening up new, potentially higher-priced markets.
Exactly. Execution, alignment, assets catalyst. That's the bull story.
And the bear case.
The bear case is almost entirely about external factors you can't control. The inherent volatility of natural gas prices, the concentration risk in Western Canada, and towering over everything, that difficult to quantify, potentially existential threat from the proposed federal emissions regulations.
Politics, basically.
Politics and commodity prices, yeah. Things outside of management's direct control.
So let's bring valuation back one last time. Stocks trading around $40 US, roughly $60 Canadian.
And our intrinsic value estimate, based on that DCF, was higher in the range of $52 to $60 US per share.
So there's a discount baked in. The market isn't giving them full credit for that $52, $60 value.
Precisely. That $8 to $60 gap, that discount, is the market pricing in the risks. It's the market saying, okay, great company, great management, but we're worried about that emissions cap potentially limiting growth, and we're not 100% sold on $4 gas forever.
So the investment decision comes down to this. Is that current discount, that $8.20, $16 margin of safety, enough compensation for taking on those two big uncertainties, the regulatory outcome and the long-term gas price?
That's the crux of it. Tourmaline is clearly a high-quality operation. The bet is on whether the known quality is cheap enough given the unknown external risks.
Okay, a very clear summary of the trade-off.
And just before we give our final thought, a quick reminder again for everyone who wants more deep dives like this one, please do like and subscribe to the Stock Analytics AI YouTube channel.
That $4.99 a month gets you the huge S&P 500 playlist, the upcoming NASDAQ 100 coverage, and the ability to request tickers you want us to analyze. Check the description for all the details.
Okay, final thoughts.
So here's something to chew on. You have this management team, led by Michael Rose, with an almost flawless track record of creating massive value. They've done it before, multiple times. And you have this huge LNG opportunity opening up. Should you bet on that proven history of execution? Or is this proposed federal climate regulation the one challenge, the one external force that even their proven playbook can't overcome?
History versus the future regulatory state. A tough one. And remember, this analysis was generated by an AI using the sources provided. It's purely for educational purposes.
Absolutely. It is not investment advice. Do your own homework or talk to a qualified financial advisor.
Thanks for joining us for this deep dive on Tourmaline Oil Corp.
We'll see you in the next one.